Good morning, everybody. Welcome to this Resolution Foundation webinar. My name is Torsten Bell. I'm the Chief Executive of the Resolution Foundation. Now, for any of you not spending your life royal watching, the main news this morning is obviously optimism based on the schools going back. And that is very good grounds for optimism. Anyone affected by it, I say with a lot of feeling. But the reality is that combines with our economy probably still being in the region of 10% smaller than it was this time a year ago. We're talking about the reopening plan coming up, but the peak in unemployment in this crisis is probably already is ahead of us rather than behind us. So the point I'm making here is that there's a large uncertainty about the nature and actually levels of the economic outlook in front of us. And it's that outlook we're going to discuss today with a speech from the Governor of the Bank of England, Andrew Bailey, who's joining us from his office. Breaking the working from home pattern of the world at present. We're all very jealous, Andrew. And then you're going to hear from Helen Ray, who's Professor of Economics at the London Business School. And we'll have a good time for discussion as well afterwards. So if you go onto Slido and look up hashtag economic outlook, you can put your questions in there. I can see that quite a lot of you have been doing that already. And we're obviously going to touch on both the nature of that outlook and how policy that's happened so far and that could happen in future fits into that context. So without any more ado, I'm going to hand over to the Governor, who's going to kick off his speech.
Thanks, Torsten. Actually, for the record, it's the first day I've been in the office this year. So,
as a treat for you as well.
Yeah, so there we are. It feels slightly unfamiliar this morning. Anyway, look, it's a great pleasure to be participating in the event today, and I wish I could say what a pleasure it was to be at the foundation, but anyway, that will have to, I guess, wait for another day. I'm going to talk about the future. And indeed the post-COVID future as the economy recovers from this traumatic experience. And if I had to summarize the diagnosis, it's positive, but with large doses of cautionary realism. So to summarize what I'm going to say, after starting with some description and assessment of the COVID shock to the economy, I'm going to draw out four what I think are important points. First, COVID has been both a demand and a supply shock to the economy. And the recovery, therefore, has to be in both elements. Unusually so, I think, in terms of historical recoveries. Because absent that dual recovery, dealing with the issues that arise will be much more difficult. Second, there are reasons to believe that so-called longer-term scarring damage to the economy will be more limited, I think, than in some past recessions. But there will most likely be structural change which will influence the future of supply and demand. Third, it's important to boost supply capacity to raise the sustainable rate of growth in the economy and thereby ease the task of managing the necessarily higher level of public and corporate sector debt coming out of this crisis. And fourth, taking all of this together and consistent with the current setting of monetary policy and the outlook for the economy as set out in our February monetary policy report, it's important, I would add, to emphasize two elements: the role of the forward guidance that the MPC has adopted and the announcements we made in early February on so-called toolbox issues, which I'll come back to. So let me start with the COVID economy. The economic impact of COVID has in aggregate been very large. We expect that by the end of the first quarter, UK GDP will still be around 12% below its level at the end of 2019, which is a huge shortfall. The impact has been synchronized across economies around the world. The similarities of this shock far exceed the differences in terms of the impact. That said, within economies, and the UK is included in this, the impact has been highly uneven across sectors. Those that conduct activity involving large amounts of close human contact have obviously been most seriously affected. And I would add that this has led to other notably uneven and unequal effects because those sectors tend to have higher proportions of low-paid workers, female workers, and there is a concentration by ethnicity as well. And I know this is an issue that the Resolution Foundation very commendably has done work on. A common question that we ask about economic shocks, always ask, is whether it's a demand shock or a supply shock. As monetary policymakers, we ask this question with good reason. The identification of shock type matters for the impact on spare capacity and therefore on inflation. So what is the answer for COVID? Well, I think the answer appears to us to be both. It's both a demand shock and a supply shock. That's not really surprising. Shutting large parts of the economy down to protect against infection affects both demand and supply. But it's highly relevant to the task of getting over COVID and therefore for monetary policy. So let me try to illustrate the nature of the COVID shock through the lens of aggregate supply and demand. The first point to make is that illustrating the shock through a calculation of an output gap alone isn't very helpful, precisely because the output gap is the net of two shocks. So if we have chart 1, please. Excellent, that's chart 1. So in this chart, I've shown the historical path of aggregate demand, GDP, and supply potential output over the last 20 years, consistent with past MPC forecasts. Now, let me add a very big note of caution. This is a somewhat heroic chart because there are several ways to represent aggregate supply and demand, and thus the output gap. But detail notwithstanding, it's clear that while a gap has opened up between demand and supply during the pandemic, the overwhelming feature is the coincident hit to both demand and supply. And that stands in marked contrast, as you can see, to the more pronounced impact on demand following the global financial crisis and the persistent period of spare capacity thereafter. Now, as well as the COVID shock, the behavior of supply and demand also reflects the nature of the policy response, and in particular, the so-called furlough scheme, because by temporarily supporting jobs, this scheme has avoided a much larger spike in unemployment, which would, other things equal, have resulted in a smaller fall in supply and a much wider margin of spare capacity. For a monetary policymaker interested in the output gap and how it will evolve in the recovery from COVID, it's clear that we need to focus on the recovery of both supply and demand. More so than usual, I would say, the recovery from COVID requires a recovery of the supply side. Some of the effects on supply directly related to restrictions on activity and voluntary social distancing are likely to be temporary and should start to reverse as the health outlook improves. And along with the vaccination programs, it enables restrictions to be eased. Changes in supply due to so-called scarring and structural change are, though, likely to be more persistent, something I'll come on to. So let me turn to the question, to what extent is the nature and form of economic activity likely to change? I want next, therefore, to take a look at a number of key aspects that will underpin the recovery. And in doing so, address a further important question, namely, to what extent is the nature and form of economic activity likely to change, and what will be the implications of that change? Now, in our November monetary policy report, we covered this ground under 3 headings: what we buy, what we make, and how we work. The key point is that the impact of COVID has required and encouraged very sizable adjustments, but it's far from clear whether or to what degree these will persist post-COVID, and therefore what will be the longer-term impact on the economy. Let me briefly describe and assess some of the major changes. Last autumn, estimates suggested that around 1/3 of workers in the UK undertook at least some of their job away from their normal place of work. As we all know, remote working has become much more common, and businesses have delivered services in new ways, often using technology to reduce personal contact. And prior to COVID, only 5% of people in employment worked mainly from home. There have also been notable changes in the way we consume. Online shopping has surged during the pandemic, accelerating a pre-existing trend. The latest retail sales figures indicate that it accounts for 35% of total sales, up from 20% in February last year. Online retailing has the potential to be more productive than through physical stores, and there is some evidence from the last decade of this already happening. Higher productivity growth in retailing has not been fully matched by higher wage growth, and this lower unit cost growth may have contributed to the relative weakness of domestic consumer prices in recent years. COVID has also caused changes in consumer spending patterns. Much of this has been of necessity, but if some changes to consumer spending habits persist, for instance, if tastes change, the pattern of production in the economy is also likely to change. The question is, how will such a process of more structural change in the economy take place, and what will be the impact? So let me turn now to what might be the implications of the changes we are seeing in the economy. This is, of course, a very big question, so I'm necessarily going to tackle it at quite a high level. The answer to the question is surrounded by a great deal of the scale and speed of the shock that has caused the changes. So let me start with employment and the labour market. In normal UK economic cycles, falls in output are accompanied initially by relatively small falls in hours worked, and then later by larger falls in employment. Employment, total hours worked, and unemployment all tend to be highly persistent. So a rise in unemployment means, based on some history, that it will be higher a year from now. That said, the UK labour market has adjusted relatively quickly to large shocks in the past. And in normal times, around 9% of workers change jobs every year. But the tendency to persistence provides evidence from the past of the effects of a mismatch between the skills of job seekers and those required by hiring firms. And as I noted earlier, some of the sectors hardest hit by the pandemic employ more young and low-skilled workers who may find it harder to move between sectors. That difficulty will be amplified if the jobs involve different tasks. Bank staff have analysed the task content of different jobs to quantify the extent of task reallocation required in various scenarios. In a relatively extreme scenario where the pattern of consumer spending is unchanged from the third quarter of last year, our staff estimate that the extent of the task reallocation over coming years would be higher than in the recent past, but much less than occurred during the 1980s and early 1990s. That was a period of significant structural change during which the share of employees working in the manufacturing sector fell from around 26% to around 16%. Now, there are two important points that I would emphasize here. First, the variation in skills demanded by employers across industries has probably shrunk in a more service-oriented economy, which would assist transition where it is needed. And second, policy intervention, particularly the furlough scheme, will help to preserve viable employment going forwards and skills specific to particular jobs or companies, which is, of course, a good thing. Now, ahead of our next monetary policy reports at the beginning of early May, the MPC will assess the impact of the extension of the furlough and related schemes announced in the budget last week. My expectation would be that this is likely to reduce the peak level of unemployment over the coming months. However, some rise in unemployment as the scheme tapers will, I think, be hard to avoid. So just as workers are often specialised, capital such as plant and machinery can be specialised for specific tasks too. And the more specialised that capital is, the harder it is to redeploy. Bank staff have estimated capital redeployability scores for different types of assets. Information and communications technology, machinery and buildings tend to be more highly redeployable with uses across many industries. There are, of course, few alternative uses for an aircraft. Capital may also be in the wrong location, even if the pattern of output is similar, if COVID results in such a change of location, for instance, related to the rise of home working. It is also reasonable to think that there is and will be considerable uncertainty over which changes in demand will prove temporary and which will persist. We do know that as of now, many people expect working from home to remain more common after the COVID pandemic is over. Half of new remote workers say they would like to continue to work from home all or most of the time, even when lifting restrictions permits a return to normal working patterns. Employers in some sectors also expect the proportion of staff that regularly work from home to more than double. And many contacts to the bank's agents expect a hybrid model of 2 or 3 days a week spent in the workplace to become more like the new normal for office workers. So what is the evidence so far for the impact of COVID on productivity and investment? Here we can turn to the information that comes from the regular surveys of the bank's decision maker panel. Labour productivity in the UK tends to be pro-cyclical. This does not appear to be the case in the COVID shock. So far during the pandemic, labour productivity per hour appears to have risen, but with a tendency to reduce over time. As we could have chart 2 at this point, please. There is, however, a lot more going on under the surface. There's been a negative impact on productivity resulting from measures taken to contain COVID. Firms in the panel estimated that COVID has increased average unit costs by around 7% in the second and third quarters of last year. And they expected this impact to reduce to perhaps 5% by the second quarter of this year, but leave a more persistent negative impact of possibly around 2%. Now, all of this reflects new costs, PPE, screens, and the impact on costs from social distancing, reducing capacity. However, this negative effect from higher unit costs was offset for panel members by what is often called a batting average effect, namely that the impact of COVID has shifted the composition of activity towards higher productivity firms. But this means that COVID has seen lower total output and higher average labour productivity. And this, of course, is consistent with the greater than normal supply side impact of the COVID shock. But it's not creative destruction in a Schumpeterian sense. In other words, it doesn't raise output through competition and innovation. Rather, it's actually a form of destruction that lowers total output and thus welfare. I should also note that evidence on the impact on productivity resulting from greater working from home is not clear, not yet certainly. Reduced travel time is a positive, but there may be lower innovation and creativity, which would otherwise come from people being together more. I want to finish this section on the economic implications of COVID by highlighting two longer term and important developments, both of which predate COVID, but neither of which is helpful. First, the UK has experienced a fall in the average rate of growth, reflecting slower growth in potential supply capacity. So we have chart 3 now. So this chart illustrates the 4-quarter GDP growth rate since 2000. And it's apparent that the average growth rate has fallen from around 2.5% in the years before the global financial crisis to around 1.5% in the period immediately prior to the COVID pandemic. We can move on to chart 4. Chart 4, this shows the same timeline for aggregate labour productivity per hour over the last 20 years. And again, the story is not encouraging. Another way of representing this is to note that the level of activity in the UK following the global financial crisis is significantly below its level at the equivalent stage following the 1930s depression, what my colleague Andy Haldane made in a recent speech. So let me come back now to the issues arising in the recovery of COVID and to turn to the 4 important points I set out at the start. First, COVID has been a shock to both demand and supply in the economy. Using an output gap measure on its own fails to capture the importance of this story. The best we can say is that how the output gap develops in the recovery from COVID will depend on the net effect of the two, supply and demand recovery, both of which will need to move by more than in normal recoveries. There is another element to this part of the story which is hard to assess at present. Namely, to what extent the more structural changes we have seen during the COVID crisis will persist and what effect they will have on the recovery. There is a lot of uncertainty around these elements. My best guess is that we will see some persistence, not full persistence, but not a full reversion to pre-COVID either. We will work more from home than we used to and shop more online because new habits will persist to some degree. And to the extent they unwind, it will take place over some period of time. The second point is that I see reasons to believe that the longer term negative economic effects of the COVID shock will be larger than we've seen, will be smaller, than we've seen in the past, particularly than we saw in the 1980s and early 1990s when they were much larger. As I described earlier, it seems likely that task and job reallocation and capital redeployment has increased since then. For instance, because workers will need less significant retraining to move between sectors. In our assessment, the supply capacity of the economy is expected to be around 1.75% lower than it otherwise would have been in the absence of COVID by the end of our forecast period. It's about 3 years. But of course, there are risks on both sides of this assessment. The third point is that although those sectors which are growing may require new capital, elevated uncertainty is expected to continue to reduce investment, other things equal, weighing on the capital stock and therefore on productivity growth. Now, I've just used the phrase other things equal to describe the likely path of investment. However, other things ought not to be equal going forward, in my view. I mentioned earlier that we've had a decade or more of slower growth and weaker productivity growth. If we can have chart 5 now. Chart 5 shows, although business investment did recover from a low base following the global financial crisis, it too was weak in the period prior to the COVID pandemic. And this was only partially offset by growth in government investment, which has also generally been weak over the same period. That's shown in chart 6. Thanks. The effect of this weakness in investment can also be seen by looking at capital services, a measure of the value of the flow of services which are derived from the capital stock, including machinery, equipment, software, structures, and land improvements. That's chart 7. This may better capture the drivers of supply growth than looking at growth in investment alone. And it shows a sharp decline following the collapse in investment during the global financial crisis, and a subsequent recovery which flattened off as a result of the weak investment in the period prior to COVID. The COVID shock has been profound and has required an increase in public and business debt to smooth the impact. This has been a necessary and sensible response. It means that the economic impact of COVID will be spread over time. How long, we don't know because it's too early to predict. But that cost has to be managed, and it will be easier to manage with a higher trend rate of growth, boosted by stronger investment. Let me add that this investment is also needed to support the transition required by climate change and the necessity of enabling a more digital economy. So these are both challenges and opportunities. But the message really is simple. Stronger growth in potential supply, supported by stronger investment and productivity growth, will make the COVID recovery easier. Now, monetary policy has a role to play here in ensuring there is sufficient growth in demand to match any increase in potential supply growth. The MPC's actions during the pandemic may also have helped reduce the extent of scarring. The bank's Financial Policy Committee is also taking steps to ensure there is appropriate supply of finance for productive investment. As part of this work, the bank, alongside the Treasury and the Financial Conduct Authority, has convened an industry working group to help overcome some of the barriers to investment in productive finance. And finally, of course, growth in potential supply is also being supported by fiscal policy. Last week's budget and the Build Back Better policy paper released by the government alongside it outlined a range of measures the government is taking to support economic growth through significant investment in infrastructure, skills and innovation. So let me end on the fourth big point. What does all of this mean for monetary policy? There is a growing sense of economic optimism in markets and in consumer and business confidence measures. The rate of new COVID infections is declining and the vaccine program is a huge achievement. There is therefore light at the end of the tunnel. But it, of course, would only become me as a central banker to strike a note of realism. Our latest forecast, the February forecast, in essence painted a picture of an economy that starts at a lower level of activity as a result of the current restrictions and people's natural caution associated with the renewed onset of COVID, which then gets back to where it was pre-COVID by the early part of next year. The level of activity in a year's time is broadly similar in the February forecast as it was in the November forecast, but the recovery is faster because the starting point is lower. Now, there's good news in that projection, with a rapid recovery later this year and inflation returning to around the 2% target. That recovery is assisted by the continued support the MPC is providing through low interest rates and quantitative easing, and in my view, it amply justifies our current stance of monetary policy. But let me dwell for a moment on three important elements of the MPC's decisions. First, we will continue to execute the announced programme of asset purchases, which we expect to be completed by around the end of this year. Second, we have in place an important piece of forward guidance, which states that, and I'm just going to read it out, if the outlook for inflation weakens, the committee stands ready to take whatever additional actions necessary to achieve its remit. The committee does not intend to tighten monetary policy, at least until there is clear evidence that significant progress is being made in eliminating spare capacity and achieving the 2% inflation target sustainably. This guidance is a recognition of the scale of the shock, the high level of uncertainty, and the risks around the COVID recovery, which are still on balance distributed on the downside, though less so as time goes by. It's deliberately state contingent. In other words, it sets out there is a burden of proof we will need on the sustainability of the recovery. But it doesn't deviate from the usual medium-term nominal anchor, the 2% inflation target. And in this context, it's encouraging that measures of inflation expectations remain relatively stable in the UK, despite the seismic shocks and unprecedented policy response we've experienced over the past year. And the recognition of the uncertainty and risks around the recovery has been backed up by separate decisions the MPC took in February on the toolbox measures that we can have and employ. Now, we've been quite clear that toolbox decisions should not be interpreted as a signal about the future path of monetary policy. We decided to ask the banks to make preparations within the next 6 months in case we need to use negative interest rates to provide further support. This implies nothing about our intentions in that direction, nor does it imply that negative rates are our chosen marginal policy tool, something in my view is state contingent at all times. We also signal that the bank will do work on the approach it would take to tightening policy, should that be needed, again recognizing that it has more than one tool to do so. These decisions are detached from our current or likely future policy decisions, but do recognize the increasingly two-sided nature of the risks we face as we hope and expect to see the economy get over COVID. Thank you.
Great, thank you very much indeed. I know we've covered a lot of ground in there. So we're going to first of all hear from Helen, and then we'll have time for some questions. So over to you, Helen.
Thank you very much, Torsten. I'm very grateful for the invitation to discuss this very interesting speech by Governor Bailey. So I think the governor has given us a very rich overview of the macroeconomic situation here. And in particular, he has pointed out that COVID-19 was a shock which affected both supply and demand, and it was characterized by a lot of sectoral heterogeneity. This, I think, together with the sheer magnitude of the shock, makes the diagnostic of policymakers in terms of the output gap and the trajectory of the output gap extremely uncertain. In the best of time, calculating an output gap is as much an art as a science, and in the current situation, it may require even more judgment. And yet, it is a key variable for monetary policy. So in my short remarks, I will first attempt to discuss uncertainty and scarcity of the economy, and also on the supply side of the economy. On the demand side, this will lead me to discuss excess savings. On the supply side, this will lead me to discuss bankruptcies and unemployment. I will also look at the broader international context in which the UK economy is operating and try to draw some monetary policy implications. So, uncertainty on the demand side. There is an important debate regarding the large amount of excess savings in the economy and whether these savings are forced savings due to lockdown, so they will disappear as the economy reopens, or whether they are really precautionary savings due to increased uncertainty. So in that case, they would not be spent, at least not immediately. Well, in most advanced economies, restrictions on consumption together with income support from governments have led to massive increases in household savings. So in the US, it is now estimated that the amount of excess savings is already on the order of $1.8 trillion, which is, by the way, of the same order of magnitude as the Biden stimulus. And in the UK, in the period between March and November 2020, excess accumulated savings were estimated to be around £125 billion, which is around 8% of annual household income. In France, there's also a lot of excess savings, for example. Given those magnitudes, it is a very important question for the dynamics of inflation in the short run, whether there will be the release of a pent-up demand for goods and services as the economy opens up or not. And on this debate, economic historians tend to argue that the pandemic will have led to precautionary savings. That's a study, for example, by Alan Taylor and his co-authors, exploiting the long history of pandemics, which points towards precautionary savings and decreases in real rate after pandemics. So does the study of the 1919 influenza pandemic by Barry Eichengreen, who also think about long-term scarring in terms of demand. But on the other hand, is that fully convincing? The recovery over the summer in countries where COVID cases were going down were relatively vigorous. And there did not seem to be psychological scarring of consumers so far at the time, at least it seems. But of course, as the length of lockdowns increased, things could turn out different. As shown by work using high-frequency data from a large fintech company in the UK, there is considerable inequality in the effect of COVID on earnings and on consumption in the UK. And by the way, this is very similar to results that have been also obtained on French data using the same type of high-frequency databases. So in the UK, one can observe that the top quartile of income distribution accounted for almost 50% of the pandemic decline in aggregate consumption, with expenditure falling for this group much more than income. It is plausible to me that this group, maybe unlike lower income groups, will make up some of the lost consumption. Of course, some expenditure will never be recouped. How many haircuts can one get? How many restaurant meals can one have? But it's implausible that some of the consumption in services in particular, restaurants, bars, culture, travels, will increase substantially when the pandemic subsides for at least part of the population. This, however, will likely be a temporary burst of activity and is, in my view, very unlikely to ignite any sustained period of inflation. Now let me move to the supply side, and the uncertainty there is also very big. So the governor discussed very important issues pertaining to the change in working habits, and in particular, the rise of remote work, but also the larger vulnerability of young and low-skilled workers. The vulnerability of workers will depend on the number of firms which will go bankrupt once the government furlough scheme and other schemes will be phased out. In France, the US and the UK, the number of bankruptcies in the past months has been actually abnormally low due to state support. But as this support is withdrawn, the increased indebtedness of firms will be harder to deal with. And this is where the monetary policy support, both for financing costs and also to stimulate demand, will be very precious. It will be, at least in my view, of foremost importance that the banking sector keeps rolling over the loans of viable but highly indebted firms, something that both the MPC and the MPC can seek to ensure by their respective means. The governor also noted, very importantly, the great weakness of investment in the UK. And supporting investment will be key. To do so, it could be desirable to put in place debt equity swaps or to use quasi-equity instruments, such as long-dated junior debt in some cases, for companies to keep on hiring and investing in the crucial recovery period. It is likely that many small firms will be highly vulnerable, and they concentrate a lot of jobs and also are geographically distributed all over the country. It is important to help companies go through the shock by decreasing their debt overhang and giving them some breathing space. It is likely that the new normal for the labor market will entail working practices with a few days at home and a few days in the office, which could be productivity enhancing in some circumstances, but maybe not always. And another trend that we may see in the labor market is that automation may have been greatly accelerated by the pandemic. Again, need for investment there. But automation and AI are not necessarily job destroying on net in the medium run, but they can be in the short run if they lead to pure labor substitution. For example, it has been observed that some industries in the US switched to automation because of COVID-19, such as in industries such as meatpacking, for example. And once they do that, they will probably not go back. So there is a lot of uncertainty there as well, I would argue, on the supply side. Now, the current macroeconomic situation was already highly unusual before the COVID crisis, with all the major central banks close to the effective lower bound and equilibrium real rates at very low levels, as we know. In that situation, fiscal policy is very powerful and is also very necessary. Hence, we are seeing that the legacy of this crisis will be, of course, a high level of government debt. Now, what we know is that the trajectory of potential output is one of the key variables for debt sustainability in the medium to long run. So in that respect as well, the weakness of investment already highlighted is of particular concern. And all the more so that the weakness of investment seems to be due both to the COVID shock, but also to the Brexit shock, if we look at the timing in the chart there. So this conjunction of these two shocks is likely to require extensive reallocation of resources across the economy, as the COVID shock is likely to have a lasting impact on some sectors, such as brick and mortar retail, commercial real estate, transport, and the Brexit shock is likely to decrease trade for a long time. As pointed out by the governor, the ability to relocate jobs and to redeploy capital across sectors is therefore likely to be a very important condition for the economic recovery. While this redeployment of resources takes place, monetary policy support will be important so that financing costs remain low at the short end and at the long end of the curve, something the Bank of England can achieve by a combination of QE and forward guidance. The coming months will plausibly see a steepening of the yield curve in the US and possibly some increase in the real rate, due in particular to the large US stimulus. The US influences the global financial cycle, and these developments, if history is any guide, will transmit to the UK financial markets in the form of higher spreads. This is unlikely to be a massive effect. But in the case the tightening of financial conditions, together with weak economic conditions, hamper the recovery, it could be constructive for the Bank of England to explore further easing policies, such as negative interest rates. So I hope we will discuss some of these themes in the Q&A. Over to you, Torsten.
Great, thank you very much, Helene. And that point at the end is a really important one, that the UK is physically an island, but it's not going to be an island when it comes to financial conditions or indeed trade patterns in the years ahead. Now, we've got about 25 minutes. So what I thought we would do is split our discussion up into three of the areas that the governor has covered. So the shorter term evolution of the economy, this medium term question on scarring / rates of change, so the permanent changes that have come from this crisis, and then policy. And within the policy buckets, we've really got two big exam questions about where marginal policy sits. What do you do if things are worse than we hope in the short term? And when things do eventually get better, and we're talking about tightening rather than loosening, what's the way in which we go about trying to achieve those objectives? So if you bring up, we've had a lot of good questions on all three of those from the audience. We bring up a couple of them now, and then I'll come to you, Governor. And they're broadly, this one is asking you in particular about the unemployment forecasts and where you think those are going to end up later in the year. As you rightly pointed out, your forecasts are before the government significantly extended the both level of fiscal support and the length duration of the CJRS. And then related to this, the second question, which is on the question that has mainly shaped monetary policy discussions so far, which is basically comes down to people's level of fear about inflation, whether they're completely relaxed in some cases or they are nervous in other cases. And if just maybe we could remove those questions a second. And then, Governor, is one way of, I read your speech is that you're optimistic about, with downsides, but optimistic about the short-term evolution of the UK economy. But unlike some others, you don't combine that optimism with large worries about short-term inflation pressures that are hard to control. Whereas some people are not optimistic about the short-term evolution, and some people are optimistic and therefore very worried about where short-term inflation goes to. So over to you, Governor.
Sure. Well, first of all, I mean, just to tackle the first question as well, I think that's correct. I mean, just to be clear on the way we do banking and forecasts, we condition our forecasts on government policy as it is on the day, as it were. So the last forecast we did was pre-budget, so we will address the budget, obviously, in the forecast we'll do in May. And as I said in the remarks I made, I would expect, much as the OBR have done, that we will have a lower profile of unemployment, certainly in the near term, and I probably think it will be lower throughout, but we haven't done that work yet, so I'll reserve that judgment. I think on inflation risk, so I go back to the chart I showed on the output gap. So given that the output gap is actually small at the moment relative to the shock, it's very small relative to the shock. I think the point I draw out from that is, given it requires this dual recovery of demand and supply, obviously you can get quite a lot of different paths, therefore, of recovery, which will have quite a different implication for what the output gap actually is at any given point in time. So it's not unreasonable to think that there's quite a sort of range of possible outcomes you can have. And you can be on both sides of that argument, and that's a point that Andy Haldane made. At the moment, I must say, viewed from where we are today, I mean, our task is to get inflation up to target. And frankly, and by the way, we will see an increase in inflation. I mean, that's sort of baked in a way, particularly because of the rise in energy prices over the last, now nearly approaching 12 months. So we do expect to see some rise towards target, but our task seems from where we sit to get it towards target and hold it there. But Andy's right. I mean, clearly there are different versions of it where you could see some different prognosis, and it's also the case, as Helen was saying, that we would then have to make the critical judgment as to whether we saw any adjustment in prices as being persistent or not. And that's going to be, quite a challenging judgment because clearly there's a lot of volatility around in the series at the moment. And that really underpins, just to re-emphasize again, why we've got this forward guidance in place. What we're trying to do there is not, obviously, what we can't because of the statute, and we wouldn't want to anyway, to abandon the inflation target. But the reason we're using this forward guidance system is to say we will need, because of the uncertainty of the path, more evidence, possibly more evidence than we would usually need, that we are seeing a sustainable rise towards inflation. So that's my current position, but we do have to be ready on both sides of this. Yeah, you're right.
That's very clear. Indeed. Helen, do you want to come on this? So one way of thinking about it, as the governor just set out, is policymakers, both on the fiscal and the monetary side, have got a lot of uncertainty about what the future looks like. Let's just focus on the short term, on this output gap uncertainty. Let's not worry about the scarring uncertainty for a second. And that means, and there's no way around that because that is a feature of the crisis. So in the end, policymakers' key judgment at the moment is, where do they sit on the balance of that, and which problem would they rather have? So where are you on how to live with that uncertainty?
So I think, as I mentioned, I am rather on the same side of the governor, I think, on this one, which is if there is a burst in demand coming from these forced savings being spent, at some point when the economy, I see that as a short possible burst of that could happen, maybe not necessarily actually very massive, but I don't think I would interpret that as necessarily a long-lasting period of inflation. And I mean, if we look at the slope of the Phillips curve, for the last decades or so, I mean, it is the case that we have seen massive changes in aggregate demand with not that effect on much of an effect on prices. Now, since we do not fully understand, however, what is behind this slope of the Phillips curve, I think this calls for caution. But I don't think that means we would lose control of inflation if we saw a little bit more.
Okay, that's great. I mean, it is a bit odd, actually. Some of the degree to which we have a discussion about whether there will be some inflationary pressure is kind of to some degree neither here nor there. What matters is the nature of the inflationary pressure. If it's partial in some sectors of the economy, so it's just a relative price shift, that can't stay permanently unless the causes of it are also permanent. In that case, presumably you'd be quite relaxed in that world, Andrew.
Well, we would look through first round effects. I mean, the clear, obviously, the sort of the canon, if you like, is to look for second round effects, but the challenge is always to sort of distinguish the two. So yeah, I mean, Helen made a really interesting point about this savings question, and just to underline how we've approached it, and we'll have to obviously approach it every forecast. I think two things. One is, Helen said, the distribution of savings, of course, is very uneven, and probably more so in the UK than the US because of the nature of fiscal policy difference. And it is more concentrated in those sections of the population which typically have a low marginal propensity to consume out of wealth. So that's, in a way, is the reason for being quite cautious about the likely spending of that wealth. But of course, you could emphasize the point I just made about typical circumstances and say, but these are not typical circumstances. That's reasonable. I mean, I say this rather sadly, as somebody who was an economic historian by past, a long time ago now. I'm a bit cautious about as Helen was saying, about the sort of the 1919 comparison because the pandemic then, because certainly the context of monetary and fiscal policy post First World War was very different. I mean, they were both being tightened very rapidly. So it's a pretty different context in that for that reason, if for no other. So I'm still somewhat cautious about the historical sort of precedents there.
Great. Let's just bring up another question on the short term before we move on to this medium term change question, which is one of the key issues obviously is the degree to which some of those savings you're talking about, Governor, get spent. And obviously they're not, we don't spend out of wealth very much, but this isn't typical wealth, and it's the most liquid form of wealth in lots of cases as well. So there are optimism reasons within that. But one other thing that's very unusual about this crisis is that although the trough of GDP is behind us, probably the trough on household incomes is ahead of us, because the very unusual nature with which government support has smoothed the income trajectory means. So and at the moment, I'd say the government's revealed position is to protect incomes while GDP is affected, but basically be relaxed-ish about incomes in the recovery, partly because of savings. So we haven't got policy that's looking to boost incomes beyond this autumn household incomes. The stimulus is focused on firms sides of things. So where does, should we be worried about the demand effect of income falls? Not huge ones, given how big the crisis is, but some income falls coming through in the autumn?
Well, yeah, that's a really challenging question, because the interesting thing, of course, about what the Chancellor announced in the budget is that, quite deliberately, I think, the measures have now been extended beyond the point that the lockdown measures are expected to be lifted. So they now bridge across to somewhat beyond that point of the lifting of restrictions, which I think is sensible. So it's the challenge, and we're going to have to address this obviously in our next forecast, so I sort of plead for time here. So the challenge, and the question is a very good one, of course, is that how is that going to smooth the path of income? I mean, as I was saying earlier, I would expect that the next forecast, much as the OBR have done, will not have the hump in unemployment that we had in the last forecast, where we were having to sort of, in a sense, project the ending of the furlough scheme before it was likely that the restrictions had fully lifted. So I would expect that to be considerably smooth, but I think I can safely say it's going to be a subject of quite a lot of debate in the forecast round that will come up in April.
That's great. Let's move on to from the impossible to predict short-term future path to the completely impossible medium-term prospects. So Andrew, why don't we start with one big question, which is, we've seen the biggest fall in output in Britain for 300 years. We have a rise in unemployment ahead of us. Investment levels have been very suppressed against the backdrop of a very bad 4 years prior to that on investment. And taking all that together, then looking at your forecast, but actually forecasts in general, they show historically very low levels of scarring, like incredibly low levels compared to, like no recent recession has seen less than 4% scarring versus its previous trend. Some of them have seen in the financial crisis kind of traumatically large levels of scarring, somewhere in between for the 1980s recession. So is it plausible we have this low level of scarring from this big a shock?
I think it is, but I think obviously as ever with the caveat that there's a lot of uncertainty around it. The reason I think it is because I say we've had unprecedentedly large amounts, particularly of fiscal support. So, and sensibly so. So, this is operated to preserve employment, to preserve companies through the lending schemes. And that, if as I expect that works in the way intended, then that will limit the amount of scarring. Secondly, I think we've now moved to an economy where there is, in some of the sectors most affected, quite a high degree of labour mobility. So if you like, the sort of the labour-specific skill element is lower. I mean, I was talking to, a major employer in the retailing sector, and they were saying to the chief executive was saying to me, look, we have a very mobile labour force in normal times. This is not this is very different from the 80s, where you had much more sort of embedded skills in the labour force, and much more, by the way, also embedded, if you like, sort of geographical specificity in the labour force. It looks like a very different situation. Now, however, I'll plead uncertainty here. I mean, exactly how that plays out, don't know. But that's why again, I sort of aim off history here to a considerable degree.
Yeah, I think that's a fair thing. And the geographical spread of it is definitely, would make you more relaxed than you might be. You're not seeing the hardest hit areas being those that already had long-term challenges, and it's very geographically dispersed. I suppose the flip side of that is, if we take out migrant labour from the UK position, then the level of geographical mobility within the UK has been actually falling over time, partly to match the falling, as you say, in your, I think one of the most interesting bits of your discussion is of the staff work on what level of change might look like post-COVID, which is has been underdone. Let's bring up a question on that, and then Helen, for you, which is basically getting at this. The aftermath of all recessions are different. We kind of always assume they'll be the same, which is why we all thought we'd get huge unemployment after the financial crisis that didn't turn up. So what is the thing that you're least confident about staying the same after this crisis? In brackets, recognizing that it's all very uncertain. So obviously you can't actually know.
So are you asking me the question?
Yes, you get the really hard one.
Yes. So as I mentioned, there are two shocks, right? Together, we have a COVID shock and we have the aftermath of the Brexit shock, and both of them affect different sectors. So in terms of the COVID shock, obviously, we have a great uncertainty about sectors such as commercial real estate going forward. But also potentially, some retail when it depends on brick and mortar. So this is some sectors which may find it a little bit longer to recover if they recover fully, which is not clear at all. For the Brexit, obviously, we have big sectoral shocks linked to decreasing trade. So what I think can lead to more scarring if we think about it, is if we don't lead properly with the debt overhang that we can see in a number of companies, which might just be viable around the periphery of these sectors or in these sectors, but which are being, under huge distress because of a higher level of debt that they will have had to actually accumulate during the crisis. So the question for these companies is how they can either roll over their debt long enough, or how they can actually do some kind of debt equity swap. And I think in the end, for the survival of the whole tissue of companies across the UK, and to decrease the amount of scarring on the supply side, the policies that will be adopted here will be very important.
That's good. Let's tie that point about companies' readiness to invest to one of the questions which has come in again from Robin there, who's trying to depress us all even further than your chart showing the long-term decline in the trend growth rate, Andrew, which is to say, we need an investment bounce back, because that's a major contributor to that slowdown in growth, not the only one, but it's a major one. Is it really going to be any different? And he doesn't say this here, but we're also obviously in the short term trying to boost investment, the timing of investment via the government's super deduction policy. But in the medium term, we're putting up corporation tax very significantly. Brexit has happened. Is it plausible? It's clearly plausible that government investment is going to be higher because the government's planning the largest investment since the 70s and sustaining it. But on private sector investment, is it plausible that Britain's going to see more investment going forward than it has in the past, or are we more realistically stuck with a lower investment equilibrium?
I think it is possible. I think, and you're right, Torsten, to really pick out two things there. There's what we do in the short term, and I think the budget was, was very sensible in that respect. And there's what we do in the medium to longer term. I think in the medium to longer term, there are reasons to believe that a higher level of investment is both necessary and be achievable. I mentioned two obvious things, which is climate change and switch to a digital economy. Both of which, as I use the words, are both challenges and opportunities. But two things. Helen is absolutely right that, of course, a challenge here is that we're going to have a corporate sector that, for the most part, is going to emerge from COVID with a higher level of debt burden A, went in with and B, ever intended to have. And I strongly support what Helen said about, having to, in a sense, enable corporate balance sheets to adjust to reflect that fact. And part of our work on productive finance is designed to do that. But also the other part of our work on productive finance is to say we have got to enable, I think, a higher level of investment. So one of the, if I can just say, one of the big things that we're looking at in the productive finance work is why the level of pension fund investment in this country in equity is so low. And what are the barriers to that? And what can we sensibly and safely do about it? Because there are probably many reasons why investment has been low in this, relatively low in this country. And if we don't tackle them now, we really are going to make recovery from this crisis very difficult.
Yeah, I mean, I think that's, if I take two things away from your speech, it's reminding us how awful doing economic change with low growth is.
Yep.
It's one, accepting that it's very hard to get your growth rate up, and two, some of the specific work on the nature of the change. Let's move to the even harder stuff, which is the policy side of things. And then, so there's a lot of questions on these. I can't do justice.
Sure.
Let's split them into two, obviously. So let's split them into two chunks. What the marginal tool would be, given your forward guidance, if things turn out to be slightly worse than we currently hope. Where I'd say, Michael Saunders was at the foundation 2 weeks ago and was making the same headline point as you, which is your tool you choose needs to be contingent on the problem you face. And I'd say, and he didn't quite get into this explicitly, but broadly he's saying, if the term premia is what you're worried about for longer term rates going up, maybe because of the point Helen raises about the US spillover, then you can use QE to get your term premium back for your long-term rates. But if what you want is just normal short-term stimulus, you should go to negative rates. I'm just putting to you what I think he can tell you what he actually said, but that's my interpretation of what he said.
I think he puts it well. I mean, in the sense that it's state contingent and it depends on the circumstances. I mean, one of the things that is abundantly clear to us is that A, understanding the impact of QE is difficult, and B, it's probably state contingent, as we said in the paper we published last year. So I would agree with Michael on that, actually. And it is, of course, interesting that if you look at negative rates, look at the ECB's use of negative rates. They actually use them in the recovery from the euro area crisis, not actually in the crisis. It's also interesting that no central bank that's currently using negative rates reduced its negative, made it more negative, has made it more negative during the last 12 months, which I don't think is an accident. But it does suggest that, certainly if you follow the ECB's argument and look at the research the ECB have published, they would have argued in their research work that, particularly because the use of negative rates really is concentrated on corporate deposits and wholesale deposits, not retail deposits, that it may have some impact in stimulating investment in a recovery. So it's, and that's why I say we've made clear it's a tool that is sensible to have in the box. How we would use them, I think, would very much depend on the circumstances of the time.
Okay. And Helen, do you want to come in on this, on short-term policy choices?
No, I think indeed the IMF has just released also a working paper on the effect of negative rates and coming down quite positively on their effect in terms of moderation. And not too negatively on the financial stability side at all. So presumably because also of the use of complementary tools to deal with that from macro-prudential policy. So I think it is definitely, of course, something worth looking into, and with a great of attention to institutional details of each country, of course.
Yeah. I would just add one thing, which is if negative rates is the marginal tool in the short term, and your problem, insofar as could be a problem, is on the household size, then for the reasons you're pointing out, Andrew, then really, I think our view would be the marginal tool for supporting household demand is probably still on the fiscal side in this crisis anyway, partly because, as you say, it's not much we're going to be able, negative rates is going to make little difference in the very short term, unless it was on a much bigger scale than other people have done. But maybe we'll be proved to be too pessimistic. Let's move on to the future, so the tightening cycle in broad terms, and the questions I'd say fall into two kind of buckets. There's quite a few focusing on the interplay between your decisions on tightening and the government's debt interest levels, pointing out that the OBR last week said that even a small tightening because of interest on reserves could lead to wiping out all of the, not wiping out, but an equivalent rise in debt interest to the increase in corporation tax, even with quite a small rise in rates. So Andrew, there's a question here from, the first one is Andrew Verity is asked from the BBC, is asking this question. He's more asking the factual question about why we're so exposed. So that's like, why do we pay interest on reserves at a variable rate, I suppose. But there's other questions saying, how big an issue do you actually think this is?
Well, let me say we pay interest on reserves because that's how we implement monetary policy.
That's a controversial.
The bank rate, the official rate, is in fact the rate we pay on reserves. And if we didn't pay a rate on reserves, we would then have to go in search for some other way of implementing monetary policy, and it wouldn't be as easy, I can tell you. So, the other thing I would say is, I mean, there's one or two proposals around which said, well, why don't you just sort of, in a sense, sort of side pocket a load of reserves and not pay a rate on them and rely on a sort of marginal rate on the rest? And my response to that is, that's actually fiscal policy. I mean, it's a tax. It's a tax on the banking system initially, but actually it'll be a tax on the economy more broadly. It'll be passed through. So I think let's be very clear on what that is. I mean, so first of all, because I have to say this, don't I? We don't engage in monetary financing. So the question about the impact of any movement in rates on the government's financial position is not something that comes into the calculation in that sense. The second thing, I would make the point, and I don't make this point in any sense to be critical of the government, it's just a fact. There have been, of course, substantial flows through the QE financing during the last 10 years as a result of rates falling and the QE program existing. So I think I'm right in saying that the cash flow that has been transferred from the QE account to the government has been in the order of about £100 billion. Now, unfortunately, of course, as rates go the other way, it's not unreasonable to think that cash flow effect will begin to cancel back out again. I mean, the other thing.
This is your version of the warning to investors that your investment can go up as well as down, or down as well as up.
Absolutely, absolutely. I mean, the other point, I'll make a bigger point just to finish off on this question because it's important. I mean, the reason that we included that language in the points in February was because looking forwards, we do need to look at this question going forwards, because for the following reason. Our current policy, which was adopted in 2018, is that we would only consider reducing the stock of QE reserves once bank rate hits 150 basis points. I haven't looked today, but certainly last week, I'm not sure the curve ever gets there. Meanwhile, the Bank of England balance sheet is going to pass £1 trillion this year. It's obviously gone up a lot. Now, by the way, there's a critical question embedded in here, which is what is the optimal and right level of reserves going forwards, for reasons beyond monetary policy to do with the financial system. And heroically, I can tell you it's larger than it was before the crisis and smaller than it is today. But there's an awful lot of.
That's very bold of you.
The amount of road between those two is a lot. But let's look on it. Let's be pessimistic for a moment. We've had two major crises in the last just over a decade, the financial crisis and the pandemic. If, let's say pessimistically, these things happen from time, and we have to use these tools, and particularly if R star, the equilibrium rate, remains low, so we remain nearer to the effective lower bound for a long time, then we do have to take very seriously what room we have for maneuver on the central bank balance sheet and how we would respond to the next crisis. So, I'm not flagging any change in policy here, but we've got to consider this issue before we sort of approach the point when we can do something.
Yeah, so that the central bank balance sheet question is obviously to some degree, although not entirely, the flip side of the government's balance sheet. The government's debt was going. Entirely, but a large part is that, and that it gets worried about from the fiscal sustainability side. But
by the way, sorry to make the other. I should have said I will make the other point. The UK actually, even if you do the adjustment for QE, the UK still has a quite a long average debt maturity relative to other countries.
Yeah, absolutely. Yeah, because of the stock, the earliest stock is on longer term. On this question that you raised, because what you just said is kind of a version of what you said at Jackson Hole last year, which one of the questions, which is we need to think again, basically, about the ordering, maybe, or the synchronizing of what a tightening cycle looks like. Just to dig on that, is your view that we basically can't have no reduction in balance sheets between recessions, is basically, and that's what we're on track for?
Well, I would simply say we didn't have a reduction in balance sheet between the financial crisis and COVID. Now, you cannot, the US did some, the Federal Reserve did somewhat. You can argue that Brexit was obviously the intervening difference in the UK. But the fact of the matter is we went between two crises and it didn't happen. We've now, the balance sheet is a lot bigger now. So, what will be the outcome of this? But I think we have to tackle that question. We can't leave it in abeyance.
Okay, so we should keep our eyes out for future misses from the bank. Okay.
Yeah.
Look, we are running over because I failed in my only duty as chair to finish on time. So, I think we should wrap up. But thank you very much indeed for your speech.
Thank you. Fascinating.
And thank you, Helen, for joining us as well from what looks like a sunnier version of London than I can see out of my window. But I'm glad someone's got some sunshine out there. And obviously, we'll look forward to seeing you continuing to answer a lot of these questions in the months ahead because they're not going away. So thank you very much to our speakers and thank you all for listening. We shall see you at another Resolution Foundation webinar soon. Goodbye.